This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and see how we actually do this accounting for deferred tax. We've seen the problem from that previous example, wasn't it? Whereby the tax expense was distorted, wasn't it? By the fact that the tax allowances were different to the depreciation, weren't they? Okay. What we want to do is we want to try and adjust for that to take account of that future tax consequence, the deferred tax. So what we've got when we go through there and account for deferred tax, there are 4 steps, 4 magical steps. If you remember the 4 steps, you can't go wrong. Okay, well, you can. Pressure does funny things to you within the exam, doesn't it? But here, hopefully, you can't go wrong. So first step is to calculate the temporary difference. Remember, it is the temporary difference, isn't it, that causes the difference within the accounting profit and the taxable profit, isn't it? Okay, so let's look at what the difference is this year. So the way that we go through and look at the difference is we take the carrying value, which you look at under your accounting rules, so here IFRSs, and then you compare that to the tax base, which looks at the tax rules, and the difference between the two is your temporary difference. Okay, the carrying value, if we focus just on PPE, takes your cost less your accumulated depreciation, doesn't it? Okay, that's nice and easy, or at least I hope it is. The tax rules take the same cost, but then just apply the tax rules in terms of the tax allowable depreciation. So I've got there your cost less your accumulated tax depreciation, or your accumulated capital allowances, or your accumulated tax allowances. It's all in the terminology. And the key bit is once you've worked out those, you've then got your temporary difference, which you then use in step 2. Okay. Step 2 is to calculate the deferred tax position. So that's looking at what goes on the statement of financial position. I'm not worried just yet whether it's an asset or liability. I'm just looking at the number that will appear on the SFP. To do that, you take the temporary difference from step 1 and multiply it by the tax rate. Rules state that you should use the tax rate that you will settle the tax liability at in the future. In most cases, that's not going to arise within your objective test questions. You will just use the tax rate that's in place at the end of the year. But if we expect that tax rate to change in the future, and it has been agreed by the government that the rate will change, use that future tax rate. But that's just a tiny little picky bit for you to consider. Okay, I think you'll find it within the study text somewhere hidden amongst all the rubbish. But that's step 2. We know the position. We know the figure on the SFP because we've taken the temporary difference and multiplied by the tax rate. Step 3 is to work out whether it's an asset or a liability. You need to learn this. You need to remember it. Do not forget it. Okay. If the carrying value is greater than the tax base, you have a deferred tax liability. Okay. Why? Okay. Well, a liability is because you're going to pay future tax, isn't it? Okay. So why, if the carrying value is greater than the tax base, will you pay more tax in the future? Well, if the tax base is lower than the carrying value, that must mean you've claimed a lot of tax depreciation. If you've claimed lots of tax depreciation, now there'll be less to claim in the future. If there is less to claim in the future, then you will therefore pay more tax, won't we? As our taxable profit will be higher in the future. Does that make sense? Let's say it again. Okay. If your carrying value is greater than the tax base, there is a deferred tax liability. That liability means we're going to pay more tax in the future. Why will we be paying more tax in the future? Well, if the tax base is much lower than the carrying value, it's because we've claimed more tax allowances, isn't it? If we've claimed more tax allowances today, there'll be less to claim in the future. If there's less to claim in the future, we will pay more tax, won't we? Because our taxable profit will be higher because there is less, isn't there, of an allowance to claim. Okay. You don't need to explain it within the exam. Remember, carrying value greater than tax base, liability. Sometimes you will find that's referred to as a taxable temporary difference. So when you're working through the steps, sometimes you need to be careful whereabouts you already are within those steps, because you may be given the temporary difference. If that's the case, you'll be told that it is taxable, in which case it's a deferred tax liability. Based on that argument, then, if the carrying value is less than the tax base, there is a deferred tax asset. That means that we are saving tax in the future. Okay, so the tax base is greater, means that we've claimed less in the current year. Therefore, there will be more to claim in the future. And if we claim more in the future, it will reduce our taxable profit and we will pay less tax. Okay, very rare that happens with our depreciation versus our tax depreciation, but just in case the examiner was to throw one in there from left field. Okay, again, just notes, if you're given the temporary difference and it is to be a deferred tax asset, you'll be told it is a deductible temporary difference. Learn them. Okay, carrying value greater than tax base, deferred tax liability resulting from a taxable temporary difference. Carrying value less than tax base is a deferred tax asset, which is a deductible temporary difference. Okay, there we go. It'll take time, but you will remember it. It'll be one of those things that you repeat as you go into the exam room about to sit in front of that computer. You'll be repeating it again and again and again and again. Okay, if you see your friends or people you don't like, repeat it again, but just do it ever so slightly wrong to put them off. Don't do that. I'm only messing. Step number 4, that's the key bit. Step 3 gave us the liability or the asset on the SFP. Step 4 is all about the movement. I can't emphasize how important it is. I will circle it. Movement. The movement on deferred tax position goes through profit or loss. So you need to look at the opening position, the closing position, and see whether that is an increase or a decrease in a deferred tax liability or a deferred tax asset. Most of the time, with your capital allowances and depreciation, you're looking at the movement in a liability. So it's all about whether there is an increase in a liability, in which case you credit the liability, debit the expense. So an increase in a liability is an increase in the expense. But if you then have a reduction in the liability, you debit the liability and credit the expense. So a reduction in the liability is a reduction in the expense. You need to practice it. You need to think about it. The questions in the revision kits, whichever one you have at your disposal, will really test you through deferred tax. But before you do that, let's go through and apply those 4 steps to the example that we have within the following video. Okay, keep your notes to one side with those 4 steps there as we work it through. So to go through and understand deferred tax and those 4 steps that we use to calculate it, we're going to go through and rework the example we saw earlier. So was that the example Tracy? And the example Tracy wants us to work out the same profit after tax, so the profits for the year. But the key bit is that we're now going to incorporate those 4 steps to work out the deferred tax, so that hopefully that will rid us of our problems that we saw earlier on. So what have we got? Well, to go through there and get ourselves started, you've got the pro formas within the notes. And we know what the profits before tax are already, don't we? They're 2,000, so 2 million for each of X5, 6 and 7. We also worked out what the current tax expense was. So was that 100 in X5, 500 in X6 and 520 in X7. Okay. What we need to do is we need to work through those 4 steps, because in the 4th step, that gives me the deferred tax movement. And if I process the movement through profit or loss, that will then give us my total tax expense and then my total profit for the year. Okay. So what you should have within the notes is your pro forma that separates it out for the 3 years, 5, 6 and 7. And that takes you through those 4 separate steps. So remember, step 1 is to compare the carrying value to the tax base. So the carrying value is your cost less your accumulated depreciation. Your tax base is the carrying value of the asset but for tax purposes. So instead of cost less accumulated depreciation, it is cost less your accumulated tax allowances. And we've already calculated the figures for that already. If you go back to your earlier example of Tracy, where we excluded the deferred tax, we know that the depreciation every year is 1 million per annum. So that's easy to work out the carrying value, isn't it? We take the cost of 5, deduct 1 to give me 4. In the second year, you have 4, you deduct 1 to give you 3. When you've got 3, you deduct 1 to give you 2. Just basic accounting. The tax base is maybe a little bit more challenging because that's taking the same cost of 5 million but applying those tax allowance rules. The 50% in the first year and then 20% reducing balance thereafter. And if you go back to the calculation, you can see that if we look at the carrying value for tax purposes, that is equal to the tax base, isn't it? So in year 1, we had an allowance of 50%, which was 2,500, which when we compared that against the 5,000 cost gave me a tax base of 2,500. In the second year, the allowance was 500, which when we deducted that from the 2,500 gave me 2,000. And then finally, in that final year, we deducted the tax allowance of 400 from 2,000 to give me 1,600, didn't we? So you have the tax bases for each of those 3 years. We can now go through and start to substitute in the figures year by year, can't we? So carrying value in year 1, x5 was 5. Tax base was 2,500. The difference between the two is 1,500. And to work out the deferred tax position, you multiply the temporary difference by the tax rate of 20%. Does that give you 20% of 1,500, which is 300? You've then got to work out, is it deferred tax liability or a deferred tax asset? And here it's a liability, isn't it? And the reasons why is because the carrying value is greater than the tax base. The reason why that is a liability is because we've claimed much more capital allowances earlier in the asset's life, haven't we? So if we claim more capital allowances early, there will be less to claim later on. And therefore, if there are less allowances in the future, we will pay more tax in the future, won't we? If we pay more tax in the future, then we're going to provide for that now and create that liability, aren't we? Once we've got the liability at 300, that's the figure that would appear on my statement of financial position. But as I said, we're focusing at the moment on the statement of profit or loss, the movement. So what you've got there is the closing liability is 300. The opening was there as 0. So that movement is 300. That movement of 300 is an increase in the liability. So I have credited the liability. The other side of the entry is to my tax expense in profit or loss. So I debit my tax expense. Debits for expenses increase them. So that increase in liability gives me an increase in my expense. That 300 we're going to go through there and put in as the movement in my statement of profit or loss. So that 300 combines with the 100 to give me a tax expense of 400 and a profit for the year of 1,600. Everybody happy with where we are so far? Yeah, good. If you want, stop the video. Work through the remaining years under your own steam, and then once you've done that, come back and then listen to how we finish the question off. Okay, if you're not prepared to do that just yet, fine, carry on, but let's give those who want to work it through a moment to pause the video. And now we're back. Okay, so X6 second year, same calculations, isn't it? Carrying values dropped by $1 million down to 3. The tax base, I think, dropped by 500 down to 2, giving me a temporary difference of 1. 20% of 1 is 200. Again, it's still a deferred tax liability. Why? Because the carrying value is greater than the tax base still. So on my statement of financial position, I now have a $200,000 deferred tax liability. However, we're not worried about the SFP just yet. We're worried about profit or loss. And what goes to profit or loss is the movement, isn't it? So what you have there, the closing liability is 200. The opening was a bit higher, wasn't it, at 300. So the movement is 100, but you then need to think, don't we, that is a reduction in a liability. So you debit the liability and credit the expense. If you're crediting the expense, then that is reducing the tax charge, isn't it, by the 100. So if I substitute that in, is it there as 100, 500 expense, 100 to net off gives me 400 and gives me a profit for the year of 1,600. Things are starting to look good, aren't they? Yeah, my profits are now the same after tax for X5 and X6. It needs to be the same, hopefully, for X7 to put to bed the issues that we had earlier on. So let's go. X7, what have we got? Carrying value, 2. Tax base, 1,600. Temporary difference, 400. I can hear you shouting the answer at me. 20% of 400 is 80, isn't it? We still have a deferred tax liability, don't we? Because the carrying value is still greater than the tax base. Closing deferred tax liability on the SFP was 80. The opening was 200. So the movement, yeah, excellent, 120. And hopefully now you're comfortable being able to see that that is a reduction in the liability. A reduction of 120 and a reduction of 120 of a liability debits the liability and credits the expense, doesn't it? Brilliant. So that's a reduction in expense of 120,000. That reduction in the expense goes there, doesn't it, into my statement of profit or loss. I net off the 120 against the 520. What does that give me? Brilliant. 400. What does that give me as my profit for the year? Yeah, 1,600. Magic. You feel the magic there. It's awesome. It's incredible. Because what you've got now is through the concept of deferred tax, you've ensured that the profits for the year are constant, which is the same as what we had with our accounting profit. So there's no distortion because of the tax charge. And also as well, you're actually seeing the benefits of a $1 million depreciation expense, because your $1 million depreciation has reduced your profits to $2 million. And if you take 20% of 2 million, what do you get? 400. What's our tax charge? 400. It's magic, isn't it? Okay. Deferred tax, one of the greatest things that you will ever see, but quite challenging within the exam. Okay. So just keep practicing the questions and see how you get on. Before we finish it up, let's just go through there and put what we have in the statement of financial position. So remember, the tax payable was our estimate at the end of each year. So was that 100 in the first year? Was it the 500 in the second? And was it 520 there in the third? Okay, because we claimed lots of allowances in that first year, didn't we? And because we claimed lots of allowances, there was much more tax to pay in the future. Deferred tax, you've got there, comes from step 3. So in X5, we had a liability of 3. That then decreased, I think, was it down to 200 in the second year from step 3. And then in the final year, I think it went through there and decreased down to 80 in that last year. What are exam questions going to go through and throw at you? Anything. You just need to be careful. You need to read the question carefully. It might ask you to work out the deferred tax liability, so going to step 3. It might ask you to work out the movement, which is going down to step 4. It might just even ask you to work out the temporary difference or the tax base. So there's plenty of scope there in these objective test questions for the examiner to test you to the max. However, whatever is asked for, you've still just got those 4 separate steps. If you can remember those, commit them to memory, and more importantly, apply them, then the questions shouldn't be as bad as what you would possibly think as at the moment. Other than that, that's tax finished. I'll see you all in the next session when I think we start to go through there and look at the world of provisions.